Hi, and welcome back to our series of videos on the simple economics of foreign exchange and exchange rates. In this video, we're going to be looking at the rise and fall of the Australian dollar and the mining boom. We're going to see how our simple demand and supply analysis can tell us how mining exports, the increase in foreign investment during the mining boom, and the Australian dollar are all related. We want to look at the Australian dollar in the period between around 2004 up to about 2014. Now here we have a graph of the Australian dollar against the yen on the left-hand axis and against the US dollar and the euro on the right-hand axis. And if we blow this up a bit, you'll see that the period that we're talking about really comes in a couple of phases. First off, we have the period starting around 2004 when the Australian dollar starts rising up against all of these international currencies. There's a bit of a dip down in the global financial crisis, but then the rise continues until we get to around 2012, 2013, 14, when it starts coming back down again. And you'll particularly notice that against the US dollar, the Australian dollar dropped quite substantially. So we want to ask, why did that happen? What drove those changes? Notice that in that same period of time, starting around 2004, going up to about 2010, 2011, we had a big increase in commodity prices. Bit of a dip down here, global financial crisis again, but overall the prices of commodities such as iron ore and coal went up until about 2010, 2012, when they started coming back down again. And if we look at Australia's two biggest exports of commodity exports, that's iron ore and coal, you'll notice that the quantity of these exports starts increasing again around 2004 and goes up. In the case of coal, levels out around 2012. Iron ore actually keeps going up until the end of this graph, around 2017. That wouldn't surprise you very much if you've seen our earlier videos on the mining boom in Australia. During this period of time, 2004 to around 2012, there was a lot of investment in Australia, opening up new iron ore and coal mines, setting up the logistics chains to export those commodities out to the rest of the world. And we can see that jump in mining investment on this graph here. Again, around 2004, mining investment jumps up far higher than the trend. The red line reflects the prediction of what mining investment would have looked like without the boom. So we've got this mining investment boom occurring in Australia until about 2012, when it starts coming back down again. And these are all connected, because the funds for the mining investment in Australia in general came from overseas. So it's part of foreign investment in Australia. So what we're really seeing here is that the mining investment in Australia drives up the demand for Australian dollars, pushes up the Australian dollar exchange rate. Then when that mining investment starts tapering off, the exports continue because the new mines and logistics chains are in place, but there's a fall in the demand for Australian dollars. They don't need as many Australian dollars anymore because foreign investors aren't extending the mines in Australia. And we can use our simple foreign exchange diagram to show all of these connections. So here we have our standard diagram, the Euro-Australian dollar exchange rate, the price of an Australian dollar in terms of euro on the vertical axis, the horizontal axis, the quantity of Australian dollars. We've got the red supply curve of Australian dollars. Remember, that's sum of imports, income payments by Australia, and foreign investment by Australia. And the blue line is the demand for Australian dollars, which is exports plus income receipts by Australia and foreign investment in Australia. And let's start off back around 2004. The exchange rate was around 0.55 of a euro to the Australian dollar. So here's our equilibrium. The increase in commodity prices on the world market means that there's a big profit incentive to expand Australian mines in iron ore, coal and other commodities. But to get the capital to do that, the Australian mining companies have to borrow from overseas or get other forms of overseas investment, and they need to change that overseas currency back to Australian dollars to be able to pay for example, their local workers. So the first effect is this rightward shift in the demand for Australian dollars. At any given price of an Australian dollar, there's now an increased demand for Australian dollars as that foreign investment, foreign dollars are turned back into Australian dollars to fund the increase in the mines. What does that do? Well, as we can see from this diagram, the increased demand for Australian dollars pushes up the equilibrium price of the Australian dollar, and at the height of a mining boom, the Australian dollar went to about 0.82 of a euro to the Australian dollar. So the price of the Australian dollar went up. Then what happened when the boom started to die down? Well, as the mining boom starts winding down, the amount of foreign investment in Australia starts reducing, and so we have the demand for Australian dollars shifting back to the left. And we get to our new equilibrium in the foreign exchange market, our new equilibrium exchange rate, which is about 0.66 euro to the Australian dollar. A couple of things to note. Notice that I didn't bring the final demand curve for Australian dollars all the way back to the original one. Why not? Well, remember, the demand for Australian dollars depends not just on foreign investment in Australia, but also on exports. And we saw that foreign investment, the mining boom, foreign investment rose and then fell. That's reflected in our demand curve going up and then coming back down. But exports also changed. Our commodity exports rose and stayed up as a consequence of that mining boom. So overall, we would expect the demand for Australian dollars to be higher post-mining boom than pre-mining boom, because we're exporting more commodities now than we were prior to the boom starting. So we wouldn't expect the Australian dollar to go all the way back to its original 0.55 euro to the Australian dollar, but to settle somewhere in between, and that's exactly what we've seen. So our simple model of exchange rates and markets for a dollar, for the Australian dollar, do a pretty good job of explaining how the exchange rates have changed over the course of the mining boom in Australia. Thanks for listening. Talk to you next time.